Let me guess. You finally saved your first 100 euros, and instead of feeling excited, you feel stuck. Because someone told you that leaving that money sitting still actually makes you poorer over time. And they're right. With normal inflation of 2%, those 100 euros won't be worth 100 euros forever. In 5 years, they're worth around 90 euros. In 10 years, closer to 80 euros. Not because you did something wrong, but because doing nothing has a cost. So now you're here, looking for a way to make that money work for you, without gambling it, without guessing, and without stressing every time the market moves. And that's exactly what this video is about. Because by the end of this video, you'll know exactly what not to do with that 100 euros, also the best decision you can make instead, and why that decision actually makes sense. And once you understand the why, taking action finally feels easy. Why most people never make a second investment. Your first 100 euros is special. It's the first time your money starts working without you, and for you. But there's a problem. Using these 100 euros the wrong way is the reason most people never make their second investment. Not because they lost money, but because they lost confidence. So before I tell you where to invest, I need to tell you where you should not put this money, because this is where most beginners mess it up. The first mistake almost everyone makes. Let's be clear, none of these things are bad. They're just bad for your first 100 euros. And the reason most beginners fail is not because they choose the wrong investments. It's because they choose investments they can't emotionally handle it yet. And that makes all the difference. When logic fights emotion, not because individual stocks are bad in the long term. They're not. In fact, if your goal is to truly change your life through investing, at some point you will have to take risks. That's how wealth is built. But here's the problem. Diversification works best when you already have a lot of money. It's a strategy the wealthy use to protect capital. When you have very little capital, diversification doesn't protect you. It slows you down. In fact, people with less money when following this strategy end up trying to protect what little they have, instead of growing it. And that completely changes the outcome. Now add emotions to the equation. Because emotionally, individual stocks are brutal at the beginning. You invest 100 euros into a single stock. It drops 15%, maybe 20%. Suddenly, you're checking the price every day. And to be honest, that first contact, seeing money move without you working, is actually a good thing. You learn a lot from it. But here's the issue. As a beginner, individual stocks don't reward you enough for the risk you're taking. You have more to lose than to gain. And I want to prevent you from feeling this after your very first investment. You don't feel like an investor. You feel like you made a mistake. You start Googling headlines. You start doubting yourself. And instead of learning patience, you learn fear. A 20 euros loss on a 100 euros investment kills motivation faster than anything else. And right now, motivation is the most valuable asset you have. Volatility feels different when it's your money. Same logic. Not because crypto is useless, not because it won't exist in the future, and not because it's a bad investment. It isn't. Long-term, crypto can be powerful. In fact, I've already explained why it might become part of the future financial system in a separate video. If you want to understand that side of crypto, the vision, not the hype, I'll leave it linked below. But as a first investment, it's a different story. Because if volatility in some stocks already feels intense compared to crypto, it's nothing. Even if you believe in crypto long-term, you still need something most beginners don't have yet. Emotional stamina. Crypto doesn't punish bad analysis first. It punishes bad timing and weak conviction. And without conviction, volatility doesn't feel like opportunity. It feels like panic. A 30% move doesn't teach long-term thinking. It teaches you how fast emotions can take control. And most people don't lose money in crypto because they picked the wrong coin, unless they're chasing meme coins. They lose money because they quit at the worst possible moment. That's the real mistake. Your first 100 euros should not train you to panic. It should train you to stay invested, to stay calm, to keep going when nothing exciting is happening. Because the real risk isn't losing money, it's losing confidence. Now, if you still want to invest in crypto early on, there is a smarter way to approach it. Focusing on real projects, real fundamentals, understanding how the system actually works. And that's something I'll break down properly in a future video step by step, without noise and without shortcuts. But not yet. Because right now, the goal isn't excitement. It's survival. Survival long enough to build momentum. Why more information isn't the answer. This one surprises a lot of people. 100 euros doesn't buy transformation. It buys fragments. A course here, a module there, a few disconnected ideas, and fragments don't create clarity. They create confusion. You feel like you're doing something, but you're not building a system. And right now, that actually increases the chance that you feel overwhelmed and stop investing altogether. And that's the real loss. Don't get me wrong. Learning is always valuable. The more knowledge you gain, the better. But let me be honest with you. You won't find a course that truly changes your financial life for 100 euros. Just for context, my data analytics intensive alone cost more than 7,000 euros. That's the reality. If you really want to invest in knowledge at this stage, books give you far more leverage. A few that genuinely shape how you think about money. Rich Dad, Poor Dad, The Psychology of Money. The Richest Man in Babylon, Little Book of Common Sense Investing. Financial Statements. Buffett Interpretation of Financial Statements. Millionaire Next Door. And if you don't want to spend weeks reading, I've already broken down the most important ideas from the first 2 books of the list on this channel. I'll leave those videos linked in the description. The point where most people quit? Here's the uncomfortable truth. Your first 100 euros doesn't fail because the investment was bad. It fails if it makes you quit. So the goal isn't to maximize returns. The goal is to survive long enough to make your second investment. And your third, and your 10th. Your first 100 euro investment is your first step to your financial freedom. Embrace it, where the snowball really starts. Up until now, everything we talked about was about avoiding mistakes. Now it's time to talk about what actually changes the game. It's important to understand why this first step matters so much. Most people believe the power of investing comes from big wins, but in reality, it comes from something much quieter and often underestimated. The real snowball starts the moment money grows without requiring time or effort. Not because of working harder or making smarter decisions, but because time itself does the work. Even if the growth feels slow or boring, growing money at around 8 to 10% a year without active involvement is already extraordinary. It beats inflation, outperforms most emotional decisions, and compounds quietly in the background. The first time this happens, something shifts. The focus moves away from getting rich fast and towards staying invested long enough for time to do its job. Time is not just helpful, it is the real advantage. The best time to start investing was yesterday, and the second best time is today. Starting earlier reduces the pressure to be perfect later, the boring choice that actually works. If time is the key, then the next question becomes simple. Which investment actually allows time to work uninterrupted? There is one category of investment built precisely for this purpose. It doesn't rely on predictions, hype, or constant decisions. It relies on consistency, patience, and the long-term growth of the global economy. A broad market index fund such as the S&P 500 offers exactly that. This approach is not about being clever or beating the market, but about participating in it. By investing this way, the bet is not placed on a single company, but on long-term economic progress itself. This is where compounding becomes powerful. Money earns returns and then earns on those returns over time. Small amounts given enough time create disproportionate results. This is also why dollar-cost averaging works so well. Investing regularly removes emotion from the process. When prices are high, less is bought. When prices are low, more is accumulated. There is no need to time the market or react to headlines. The biggest return on your first 100 euros doesn't show up in your portfolio. It shows up in the fact that you never go back to being someone who doesn't invest. That $100 isn't your first investment. It's the moment you start playing a different game. And once you're in that game, time finally starts working for you. If you want to understand how much you could potentially grow by investing in the S&P 500 over the next years, based on how much you can invest every month, and how to choose the right index fund, I break all of that down step by step in the last video I released. And if you're looking for clear information about the best brokers to start investing with, I also have a recent video where I compare the best options and explain exactly what to look for.